What happens to your RSPs when you retire? How do you convert it, withdraw from it, and avoid unnecessary taxes? If you're nearing retirement, these are questions you need answers to. And in this video, I'll break it all down. Hi, if you're new here, I'm Darcy Bell, a certified financial planner with IG Wealth Management. I work with business owners and professionals across Canada to help them grow, protect, and optimize their wealth. If you're looking for actionable financial strategies, hit like, subscribe, and share this with someone preparing for retirement. Part 1. What is an RRSP and why convert to a RRIF? An RRSP, or Registered Retirement Savings Plan, is designed to help you save for retirement with tax-deductible contributions and tax-deferred growth. But here's the catch. By December 31st of the year you turn 71, you must convert your RRSP into an RRIF, or Registered Retirement Income Fund, or another retirement income option. Why convert? 1. Mandatory withdrawals. A RRIF requires minimum annual withdrawals starting the year after you set it up. An RRSP doesn't. Number 2. Tax planning flexibility. With a RRIF, you can better manage withholding taxes and cash flow. Number 3. Avoid penalties. If you don't convert by 71, the entire RRSP balance becomes taxable income. Ouch. Example, let's say someone is 71 with a $500,000 RRSP. Not converting it means facing a massive tax bill. Converting it to a RRIF allows gradual withdrawals, potentially saving thousands in taxes over time. Part 2. Understanding withholding taxes and minimum withdrawals. Once you have a RRIF, you must withdraw a minimum amount annually based on your age. For instance, at age 65, it's about 4%. With $200,000 in a RRIF, that's $8,000 that must be withdrawn that year. How does withholding tax work? Withdrawals up to $5,000, 10% is withheld. From $5,001 to $15,000, 20% is withheld. Over $15,000, 30% is withheld. But here's the key. The minimum withdrawal from a RRIF has no withholding tax. Withdrawing more, that's when withholding applies. Example, imagine needing $20,000 for home renovations. Withdrawing from an RRSP, 30% is withheld from the entire $20,000. Withdrawing from a RRIF, above the minimum, withholding taxes apply only on the portion above the minimum. Planning withdrawals strategically can prevent the CRA from holding more of your money than necessary. Part 3. Strategic conversion timing. Do you have to wait until you're 71 to convert? Absolutely not. And often, it's smarter to convert earlier. Why consider early conversion? Bridging early retirement. Retiring at 60 with low taxable income, drawing from an RRSP, or converting to a RRIF early can reduce lifetime taxes. Coordinating with CPP and OAS, accessing RRSP/RRIF funds before government benefits kick in can improve tax efficiency. Smoothing out taxes. Taking smaller withdrawals earlier may prevent large mandatory withdrawals later, which could push you into a higher tax bracket. For example, someone aged 62 converts part of their RRSP into a RRIF, withdrawing $15,000 annually before 71. This approach helps keep taxes manageable while reducing future withdrawal obligations that could trigger OAS clawbacks, partial conversions. You don't have to convert the entire RRSP at once. Moving smaller amounts each year can strike a balance between tax efficiency and cash flow. Part 4. Spousal RRSPs. Income splitting and tax credits. Spousal RRSP considerations. If contributions were made to a spousal RRSP in the last 3 years, early withdrawals may be taxed back to the contributor unless you withdraw only the RRIF minimum. Income splitting. From age 65 onward, up to 50% of RRIF income can be split with a spouse, potentially lowering the combined household tax bill. For example, a couple earning uneven retirement incomes can use income splitting to redistribute $20,000 from one spouse to another, reducing their overall tax bill. Pension income tax credit. Once you turn 65, the first $2,000 of RRIF withdrawals qualifies for a tax credit. This means you can withdraw that portion effectively tax-free if no other pension income is present. Part 5. Here are some practical tips and common mistakes to avoid. 1. Consolidate accounts. Multiple RRIFs lead to multiple tax slips and more complexity at tax time. Consolidating into one account simplifies both withdrawals and paperwork. Review investments. Converting to a RRIF doesn't force you to sell investments. The assets simply transfer over. However, reviewing your portfolio to match your income needs and risk tolerance is a good idea. Number 3, watch out for OAS clawbacks. High RRIF withdrawals can reduce old age security benefits. Spreading withdrawals over multiple years can help avoid this. Number 4, expect an adjustment period. Your first year of retirement withdrawals may feel overwhelming. That's normal. Planning ahead helps smooth the transition. Number 5, plan for healthcare costs. While public healthcare covers many expenses, out-of-pocket long-term care or private medical services can be significant. Your RRIF can help cover those costs. Planning your RRSP to RRIF conversion doesn't need to be complicated, but it does need to be done right. Click the link in the description to book a free, no-obligation consultation with me. I'll help you build a strategy to minimize taxes, maximize your income, and give you peace of mind throughout retirement. Thanks for watching. Don't forget to like, subscribe, and drop your questions in the comments. I'd love to hear from you. See you in the next video.